Good afternoon, good evening. Good evening, Chris.
Good evening, Chris. Yeah, Australia.
Thanks, boys, for having me.
So we've got Nigel in Mauritius, me in Malta. Matt, I presume you're in London.
I'm in
And Chris
London,
over
sunny London.
in Sydney, Chris, you said?
That's right.
And an audience from all over the deVere world. Let's just give it another 60 seconds, please, chaps, as there's still lots of people logging in, and then we will get rocking and rolling.
Yeah. But if me and James can see the participants going up quickly. Okay, so
Yes, I think markets and sort of geopolitical rhetoric is probably the reason why a lot of people want to get involved in this conversation, I guess. There's lots going on.
Always impresses me when I know a number of the people that have logged in, number of the clients as well. The global reach of these things, the countries that people are in, New Zealand, Australia, India, lots from Europe. Fantastic. Fantastic. Okay, I think we get started with the time at 2 minutes past. Good morning, good afternoon, or good evening, depending on where you are in the world. Another fantastic deVere webinar coming up. Delighted to introduce you. If you don't know him, I just said he's deVere's most favorite fund manager. Should I have said that? I don't know, but I think he might be. Christopher Joy, who is the fund manager for the DVAM Smarter Money Fund, which has just gone through $100 million. So a big thank you to everybody for your support there. In his spare time, of course, he's the co-founder of Coolabah Capital Investments. Matthew Lamb, who is the CEO of Pacific Asset Management. But first of all, I'm going to hand over to Nigel Green, who is the CEO of deVere Group.
okay, thank you, James. Big welcome again from me. I think deVere's advantage, secret edge, is that we've built a company which is the largest advisor of cross-border advice around the world. And of course, that gives us a fantastic opportunity in the marketplace to be able to speak to the top fund managers, which is exactly what we're doing today, and also to produce products for our clients that are exclusive. And I'll give our clients that edge. How do you give them the edge? It's give them the information, make good funds available, and really give the opportunity to ask questions to top people. And that's exactly what we're going to be doing today. So, Matt, if you can, introduce Chris, okay, and just talk about how we've developed the DVAM range.
Well, thank you very much, Nigel, and thanks, everyone. Welcome all over the world. I'll spend 1 minute just talking a little bit about DVAM, because I think one of the things Nigel just mentioned there is the word information. And the sort of empirical evidence when it comes to staying, to winning with investing is staying invested. And staying invested is about having the evidence, the sort of information and the reassurance of what's going on in markets. And often fund managers can sit in ivory towers, and you don't often get the ability to communicate and interact with fund managers in the way that you perhaps should, to make you feel comfortable, to allow you to stay invested, to allow you to win over time. And not only that, when you've got a complicated business like the deVere Group, which is a cross-border behemoth, basically providing advice across multiple jurisdictions, and not only that, who's very significant in size, so should be maximizing their purchasing power. And many years ago, Nigel and I got together to discuss how we could build a sort of virtual asset management for the deVere Group, which became DVAM. The regulated entity behind DVAM is Pacific Asset Management. We're a $17 billion UK and SEC regulated organization in the UK, running money for global clients, institutions and wholesale and retail clients, and with a big sort of tech architecture. And what we wanted to do through the DVAM branded range of funds was to work with Nigel to understand the sort of strategies that were necessary and useful for their clients so that they could compound their assets over time. And a way of doing this to allow people this sort of seamless allocation to fund managers across borders, across currencies, US dollar, Australian dollar, GBP, Swiss franc, sterling, available in cross-border jurisdictions. And sometimes we could find great fund managers, but didn't have that breadth of reach across the border. So by building the DVAM fund range, we could allow access cross-border, multiple jurisdictions, multiple currencies. And at the same time, Nigel and Nigel's clients could pool their purchasing power to make sure that they were also giving the very best prices and fees for clients. And the whole idea was that wherever you are, in whatever part of the world you are, you've always got the best person running your money at the best price. And that was really the goal for deVere. And we run now equities, both income and growth. We run multi-asset funds. We run alternatives. And the latest addition to the universe of deVere funds was our exposure to credit. And that's where Mr. Joy comes in. Mr. Joy, Chris Joy, a very well-known financial commentator. He's advised government institutions, including the Barack Obama administration, which might be, not the right thing to say in a world of Trump, across the world. But perhaps most importantly, James says, he's the founder and CIO of Coolabah Capital. Coolabah Capital, a global investment-grade credit powerhouse. In fact, Chris now and his team trade hundreds of millions of dollars of investment-grade credit every single day. And he built the deVere product in conjunction with deVere and Pacific to deliver a return investing in the most safest companies in the world, to try and deliver returns in excess of cash, 2% in excess of cash. And we're a year in. He's on target for doing all of that in what's probably been one of the most crazy 12 months since we launched this strategy. And so, Chris, welcome. Thanks so much for giving your time up and talking to the guys. Before we start, do you want to tell a little bit about Coolabah, what you do, why you do it differently, what you're trying to give deVere clients and the deVere funds exposure to? Because you're not playing in the lower part of the capital structure. You seem to be investing in the safest companies in the world, yet still generating these sort of excess of cash returns. So it'd be great to hear about that for 5 or 10 minutes. And then we might pick your brain, and Nigel's for that matter, on markets and where we think the world might be going.
Yeah, thank you, Matthew, and thank you to the team. And thank you to the 374 people who are currently online, and doubtless many who will watch this on demand. We really appreciate your engagement, your support for deVere, for Matt, and for the deVere Smarter Money Credit Fund, which is quite unique insofar as it's a strategy that's customized for your requirements and specifically the goals we set out, which is to target before fees 200 to 300 over cash, to provide very strong daily liquidity, to be a floating rate product that doesn't have interest rate risk, and to be a super high grade bond solution. What that basically means is, since we launched the strategy has had almost no return volatility. Our return volatility has been less than 1% per annum. That's 1/15 the volatility of equities. Daily liquidity, as we discussed, and an average credit rating in the A to AA band, so super high quality. We're not interested in taking really any risk at all in these strategies and in this particular portfolios. We're targeting a couple of 100 basis points above cash. Our current yield is about 100 basis points over cash. And really, this is a strategy that should supplement and augment your existing deposits and cash holdings by beating cash, but providing you with exceptional liquidity and exceptionally low volatility, and ideally de minimis correlation with other asset classes. So on the 14th of March, you might remember, I think we might have had a webinar around that time, but certainly on the 14th of March, I wrote in one national newspaper that we expected you bearish coming into the very bearish coming into the Liberation Day event. As it transpired, the S&P 500 fell 22% and the NASDAQ fell 27% through to the 9th of April. On the 9th of April, we cut all of our hedges and we started aggressively buying bonds. So on that day alone, we bought $2 billion of bonds, and over the rest of April, we bought $5 billion of bonds. I'll come back to macro in our conversation with Nigel and James and Matt later. And our positive outlook right now remains afoot. But that's a good example of the very high levels of activity that we deploy in this strategy. So the strategy itself involves us buying and selling the safest bond issuers and bonds in the world. We're trading what are known as the investment grade bond market. So typically A to AA rated. We don't want companies with any default risk, companies that have any business model risk. As some examples, we have never traded Deutsche Bank bonds. We've never traded HSBC bonds. We've never traded Standard Chartered bonds. Now, there's nothing wrong with those companies. They're just too risky for us. Another example is we put a ban on Credit Suisse in 2021. They blew up in 2023. In other strategies, we run long-short strategies. We were shorting Credit Suisse bonds in 2022. And the markets we trade are intrinsically very safe. So there's 7,000 investment-grade bond issuers globally. We only allocate to 4% of them, or 305 names. They're the biggest companies in the world. Google, Meta, JP Morgan, Barclays, Lloyds, etc. And really the condition precedent for coming into your portfolio is you cannot have default risk, because if there is any hint of default risk, we won't be able to trade the bonds, and we like trading the bonds. Over about a third of $1 trillion, or over $300 billion of trades, we've made money 80 to 90% of the time. So our win ratio in bond markets is extremely high. You might ask, how can you make money 80 to 90% of the time? The bond market does not work like the equity market. When shares trade on an exchange, we trade about $1 billion Aussie a day around the world. Most of our trading is in the US dollars and euros, but we trade about $1 billion Aussie a day. And when we trade $1 billion a day, the prices and volumes are never reported anywhere. If I trade $1 billion of equities, everyone in the world sees the prices, they see the volumes, and 90% of the trading on the equity market is algorithmic. There really are few to no algorithms in bond markets. Trading bonds is done over the counter, unlisted. It's like trading shares before stock markets existed, if you could imagine it that way. It's actually very similar to trading houses. If you buy and sell a house, you ring up the real estate agent, you put a bid in, it trades. It's the same in the bond market. We trade with 80 banks. It's all voice executed. So we do no electronic trading. It's all voice executed. But Coolabah's process is highly digitized in the sense we're very quantitative. So I have 53 guys around the world. In London alone, we have 4 traders, 5 analysts. We have traders and analysts in Miami, Auckland, Sydney, and Melbourne, as well as London. And we are just looking for bonds paying too much interest margin for their risk. So I want to buy a Barclays bond paying 5.25%. That really should only pay 5%. And when that yield comes down, we get a little bit of price appreciation. It's like you buying a really cheap stock that's trading on a high dividend yield. And as the share price appreciates, you get a capital gain and the dividend yield comes down. We're doing that about $1 billion a day, every day. We're making money 80 to 90% of the time, and we're making very small capital gains. The typical capital gain on our last 30 billion of trades has been about 0.5%. So small capital gain or small price appreciation, but it's compounding up into significant returns. And that is really the heart and soul of the DVAM Smarter Money Credit Fund. It's really an enhanced cash strategy, or like a money market fund, for want of a better description. I mean, that's a terminology that may or may not be appropriate depending on your jurisdiction. But think about it as cash plus 200 to 300 before fees, and daily liquidity, A to AA rated. And it can sit in my view, if I was talking to myself, in a multi-asset class portfolio. It's the liquid cash-like bucket that you can use as you move in and out of equities, property, crypto, whatever the other exposures you might have.
Chris, can I ask you a question just on the subject of this, just to delve a little bit deeper on the quality of bonds? You've talked about in the past that, if you are a depositor, you're effectively taking the credit risk of a bank. But often when you put because by putting deposits, you're lending your money to the bank for them to go and do stuff with. And as a depositor, you're often getting no return. And yet if you bought the highest part of the capital stack of the bank, you're getting a cash plus yield. Do you want to talk a little bit about that piece? Because it seems like almost taking similar sort of risks.
So take JP Morgan or Barclays. JP Morgan and Barclays are banks. And their capital stack, their funding, the money, when they make a loan, when JP Morgan lends to US households or Barclays lends to UK households, they're getting that money from somewhere. And if you think about their balance sheet, roughly speaking, about 10% of their money comes from shareholders. That's equity. That's what trades on the stock market. And 90% comes from debt. And that debt is a combination, typically about 2/3 of bank deposits. So when you put your money in a bank deposit, you're lending money to the bank. It doesn't feel that way. You just think of cash deposit, da-da-da-da. But actually, you're lending money to the bank and they pay you an interest rate in return. Often they pay you nothing. If you have a transaction account with a big bank, they pay you typically nothing at all. So you're lending money to the bank for free. But that's only 2/3 of the debt the bank borrows from us, the world. The other 1/3 is from the bond market. And bank bonds commonly pay 5-6% interest rates. That's why today in the DVAM Smarter Money Credit Fund, we're earning a yield of about 5.5% or about 100 over cash, right? And it's also why pre-fees, our total return annualized is sitting at 6.5 to 7, because when you add our trading alpha, our trading gains on top of that yield, you get up to close to 7% from that additional edge, from that those small mispricings that we're prosecuting. So the crucial thing is you can put your money in a bank deposit and accept the lowest possible interest rate the bank's ever going to pay, right? The crappiest rate of return you'll ever get is when you lend to money via a bank deposit, Alternatively, with the DVAM Smarter Money Credit Fund, you can lend to banks via their bonds, which is exactly what we're doing. And you're getting much higher interest rates because Chris Joy is far more demanding than Mrs. Joe Blogs, who walks down May Street and blindly puts money into the Barclays transaction account. When I'm giving, like recently, we put, I think, about 350 million into a Barclays bond, and I set the interest rate on that Barclays bond. So I literally negotiated with the global treasurer. I said, no, you need to pay me. In that case, I think they paid us 190 over cash, over the cash rate, over the Bank of England, policy rate. And we are, hand-to-hand combat, trying to extract as much interest rate margin from the bank as possible. And then as soon as the market realizes that we've got too much margin, the margin drops, the yield falls a bit, we get a capital gain, and then we sell those Barclays bonds and monetize that.
So the other thing to mention, Chris, that was super helpful. I'm very clear. So the other thing to mention also is that obviously when you put your money in a transaction account, as you called it, or a current account, as we call it in the UK, effectively you have instantaneous liquidity. I can go into the bank and take it out. You mentioned at the beginning, often in the UK or in anywhere else in the world, I want to get an uplift on my yield. I have to lock my money away in a savings account for 6 or 12 months. But in the Smarter Money Credit Fund, we also have daily liquidity. So, you can get your money out with a few days. So it almost feels like a current account. So two things, we're getting the liquidity because I guess they're the most liquid bonds. But two, how are you dealing with the interest rate piece? Are you buying, very short dated bonds, so they almost feel like cash, or how are you taking out the interest rate risk? So
these are really profoundly important points that I want to address. So in the DVAM Smarter Money Credit Fund, we have no interest rate risk. It's basically a floating rate strategy. What that means, guys, is you have a term deposit or a fixed term or fixed rate deposit where you might lock your interest rate at a bank for 12 months. And then you have a variable rate or floating rate deposit or a savings account where the interest rate moves up with the Fed rate or the Bank of England rate or the Reserve Bank of Australia rate. DVAM Smarter Money Credit is variable rate, okay? And that's because we've hedged out all the interest rate risk. We've also hedged out all the FX risk because we're lending to JP Morgan, we're lending to CBA in Australia, we're lending to Barclays, we're lending to the safest banks in the world. That's basically what the DVAM Smarter Money Credit Fund is really a lender to the safest banks in the world. Occasionally, we also lend to Google, Meta, perhaps a Verizon or whoever the case may be. But most of it, we're lending to the banks and getting you much higher interest rates than you would otherwise get on your deposits. What was the other point you mentioned?
We just talked about liquidity.
Oh, the liquidity. Let me give you a terrible personal anecdote. Unfortunately, my financial advisor put me into a UK litigation fund. And I said to him, I need to fund a renovation in 12 months. He said, that's fine. This UK called the Catch Litigation Fund. He said, listen, no problem. You'll be able to get, they have 12-month liquidity guaranteed. These loans amortize very quickly. The interest rate's incredible. It's 14%. We've been investing with this manager for years and years and years. I get an email this week. Sorry, Chris. There's been a run on the Cash Litigation Fund. The underlying assets are liquid. Your $400,000 will now be locked up for 3 years. My mother had $1.5 million in this fund. You're seeing private credit funds gate and close all around the world. You're seeing commercial property funds do the same. So this issue with illiquidity is very, very serious indeed. And particularly in times of stress, if anything's remotely illiquid, you will not be able to withdraw your money. And I've been personally impacted by that. And I hate illiquidity. That is the only illiquid investment, that cash litigation fund, that I've ever touched in my entire 48 years.
You should have come to deVere, Chris.
There's 399 financial advisors that will give you
I actually called one of your deVere advisors straight after this, and I said, listen, I need help because this is absurd. And it was only a small part of my, it was a tiny part of my portfolio, but the advisor was, convincing that it's fine. If you want to take money out, it's this 12-month notice period. Well, I put my notice in April. Fast forward to September, I'm now told that I'm gated for 3 years. It's unbelievable. So
liquidity is key, and I think that's one of the things that we wanted to do. And for all investors, obviously Chris is regulated and does all the right things and runs money for some of the biggest institutions in the world. But you also have the other comfort that the DVAM funds are an extra layer of regulatory protection. So actually, we give Chris a hard time as well to make sure he's delivering on what he said he was going to do and what the prospectus does. And that we is a royal we. That's Nigel, that's James, that's me, that's DVAM, that's Pacific. So effectively, a highly liquid, highly safe, highly active investment grade bond fund. that can give you great predictability. And volatility I talk about as a measure of predictability. And the lower the volatility of something, the more predictable the outcome. And so when you're running something like a 15th of the volatility of equities, you can take great reassurance in the sense that there is a huge amount of predictability in what to expect from this portfolio. Let's move on a little bit and talk about markets. I might bring Nigel in on this as well. So, let's talk a little bit about equities. Chris, you mentioned briefly to us that you were sort of bullish on Trump and the US economy. Firstly, do you think Trump's tariffs are going to pay for his fiscal stimulus? I guess that's the next question. Two, if it does, plus deregulation, doesn't that mean the US economy booms and we should all be buying more US equities?
Are you asking me that question or Nigel?
Yeah, well, I'll ask you first and then I'll go to Nigel.
Yeah, I'm super bullish on what Trump's doing. It's extraordinary. And the problem with Trump is everyone projects their personal prejudices on Trump, unfortunately, because he's such a hyperbolic, divisive, and polarizing personality. It's very hard to have a sensible conversation. But let me just give you a few facts. The most independent arbiter of US fiscal policy is the Congressional Budget Office. 2 weeks ago, they said, we got it totally wrong. The tariffs are now going to raise a huge amount of additional revenue that we didn't expect, even accounting for the fact that consumers will substitute away from tariff goods. So they now estimate, the CBO, that the tariffs are going to raise $4 trillion. The cost of all of Trump's fiscal stimulus in the so-called One Big Beautiful Bill Act is $4 trillion. So previously, every economist in the world was telling us that Trump was going to blow up the budget. There was going to be a tremendous deterioration of the budget deficit. US debt to GDP was going to go through the roof. Now they're saying there's not going to be any change in the budget deficit at all over the next decade. This is the CBO, not Trump. So the tariffs have been profound because they're generating huge revenue. That's the first point. The second point is they're bringing back supply chains. They're encouraging US manufacturers to invest in US manufacturing. And that's a massive process. You're going to get the mother of all CapEx booms in the US. And the final point is it's actually optimal tax policy because the tariffs are basically like a huge VAT or GST or RST, whatever you call. They're a massive consumption tax because the cost of the tariffs are being paid by US consumers. At the same time, so Trump has basically instituted a huge consumption tax in the US while cutting income taxes, which is optimal tax theory, right? You've got a big flat consumption tax and you reduce income taxes, and he's deregulating. So the US economy, we always thought the data would be patchy in the first 6 months of 2025, and it'll continue to be a bit patchy, but the Fed's cutting rates, that's super positive. You've got very positive fiscal policy. He's removing all regulation or deregulating. And then finally, he's incenting the biggest CapEx boom that we've seen in many, many decades. So I think the US economy is going to be running at a tremendous pace.
What does that mean for interest rates? Because obviously some of this could be seen as inflationary. Are rates really going to back to 2%, 3%?
The Fed's going to cut rates in September, and they'll cut rates a bit more. They should have cut rates earlier, but they're at 4.25 to 4.5, and the deVere Smarter Money Fund's basically giving you a yield about 100 basis points above that if you're in the US dollar unit class. The Fed will cut rates a few times, but there's probably not that much room to cut because the US economy is going to be so strong. Long-term interest rates have stayed relatively elevated. UK rates are high. Rates in Europe have been high. US rates are sitting just above 4%. And I think they'll stay elevated. So I think we're going to stay in a high rates for long environment. And that's not a bad thing because if the US economy is booming, I think we're going to get massive productivity gains from AI. We're seeing this. US productivity growth, which is output per hour worked, is booming, right? European productivity growth is actually pretty good. The most unproductive, laziest sons of motherless goats in the world right now are unfortunately my countrymen in Australia. We've got the worst productivity growth in the world. Set aside that. But high growth means high interest rates. Just think about it that way. And I do think we could get a revival of inflation in 1 to 2 years' time because Trump is not allowing any new migration, or is it making it very difficult? And so labor supply is likely to be somewhat inert, and you could get wage pressures. But I want to be very clear. Since 9 April, we've been super bullish, and I find it hard to get negative right now. Equities are rich, we all know that, and interest rates are relatively elevated. But there's a lot of good things happening in the world. Trump single-handedly resolved the conflict, the massive military conflict between Iran and Israel. He's overturned European defense policy, forcing NATO members to go to 5% of GDP in terms of defense spending, which is a fiscal revolution. The Germans have dropped their fiscal austerity, and they're going to spend over 700 billion euros on defense and infrastructure. So you're going to get a defense led investment boom in Europe, and there's hopefully some prospect of a resolution of some sort between Russia and Ukraine at some juncture. So I'd like to think that the world looks. I think the biggest risk is stability. I think we could be surprised by how much stability we see in the immediate period.
This, I love I'm loving this. I'm loving this. I read the news every day and get a little bit depressed. And now Chris is championing stability. Nigel, what are clients thinking? I mean, obviously you're in this unbelievably fortunate position where you get to see what the consumer's thinking, all over the world.
Yep.
What are their views on equities? Are people moving up the risk scale, or are people still pretty scared? And maybe they're more scared about the news flow than what the actual markets are doing.
Yeah, I mean, I think Chris's comments, I'll argue with some of them, okay, because I think we probably should. So I'm not so bullish on Trump, although I do agree with the conclusion. So, okay, we'll actually end up in the same place. I think tariffs will have some effect. I think, unfortunately, the rich are getting richer and the poor are getting poorer. So I think, you do have potential social issues. You're already seeing some of those signs in lots of different countries around the world, and I think that's going to continue. So, you never can look at the sky in the investment market and say there's no clouds, because there's always something that could potentially happen. And I think if you're an investor, the sky's never blue, right? There's always something to be concerned about. And that's why I'd always look at diversification, simply and solely because of that. Fed are going to cut rates. They should cut by more, but they're cut by 0.25. And the reason they're going to cut is the unemployment rate in America is increasing. So just think in general, you get wage inflation causes real inflation. So when you get inflation, there's lots of different things can occur. Obviously, COVID, you get supply chain issues that can cause it, but it tends to be more temporary. But when you get a tight labor market and companies struggle to hire other people, then you get wage inflation. Okay, when you get wage inflation, you get real inflation because it gets passed on to the consumer. Right now, we're seeing a situation whereby the labor market in the in the US is struggling. So there's more room for the Fed to cut rates. That's good for equities, exactly as Chris says. There's an opportunity for equities to go even further. Yes, there are some clouds on the horizon. So, I wouldn't just go 100% into equities personally, even though overall I'm positive. If you go back historically, when the Fed starts to cut, if they cut because the economy is crashing, no sign of that at the moment, labor market struggling, but no sign of the economy crashing, then the markets on average increase by 50%. So far, the markets have increased by 15%. So there's upside as the Fed start to cut. There's a lot of money in money market accounts. So a money market account would be similar to what Chris is managing in its style, except it's not going to give you the same return as Chris's because he's managing it effectively. But money will come out of that in America as interest rates come down, and that money will go into some equities. I'm positive on defense, as Chris said, in Europe. I think Europe's kind of woken up. I'm not as optimistic on Russia as Ukraine as you, Chris. I hope so. My fingers are crossed. But I think defense stock will do well. I think you see what Warren Buffett's doing. I mean, he's put lots of money into exactly what Chris is doing. In effect, he's investing in bonds because he wants a secure yield. But he's also investing in the healthcare industry. So some of his investments are defensive by their nature. I think if you're an investor right now, depends on your attitude towards risk. But if you're risk adverse, then look at it exactly as Chris describes. If you can put your money in a bank account, but you're going to lose because inflation is going to be there to some extent. You're going to lose money in spending terms. If you put it into a smart money fund, you're going to be gaining a good return. You're going to be above inflation. You're going to be making money. If you go into equities, then equities can be volatile. The valuations are stretched. Yes, there is upside, but volatility. I'm going to go, Chris, even though, okay, you're bullish. There's likely to be some volatility. Okay, it would be unusual not to have some volatility in the equity market. So I'm 100% positive on equities. I wouldn't put my money in it. Okay, I'd rather have that spread.
I mean, I think a couple of points you both mentioned actually, and I think that as multi-asset investors on our side, one of the things that you have to think about, which hasn't really happened in the past, and that is the dollar weakening. we've ended up with an environment where the dollar has been perpetually strong, and as non-US investors, as European sterling-based thinkers, we've benefited from a stronger currency and a strong equity market. And then whenever there's been a crisis, what's ended up happening is there's been a flight to safety and the dollar strengthened. So sterling-based portfolios in some of those numbers that Chris talked about in Liberation Day, minus 20, 25%, actually in sterling terms, they weren't quite so bad. Same in 2008, same in 2020. And I think if Trump can deliver, and if Trump gets what Trump wants, and people say, you shouldn't fight the Fed, well, maybe you shouldn't fight Donald Trump. If you shouldn't fight Donald Trump, he's made it very clear he wants a weaker dollar. And if he wants a weaker dollar, then I think from an equity perspective, that could see investors to look at other parts of the world to generate returns. Emerging markets.
I don't think it's just Trump wants a weaker dollar. I mean, that's true.
Yes.
But I think the world has less confidence in America. Debt's increasing. Very difficult to uncouple from the dollar because commodities, everything's traded in. So that provides some sort of floor for the dollar. You've seen gold go up, and that's almost become an alternative. So I think the world is less positive.
Well, it subscribes to a weaker dollar. I mean, if you look at, and that's why EM and other strategies, and also if you're a US investor and you're investing in European equities, you've now got the opposite. You've ended up 15% of currency appreciation and 15% of equity market appreciation. So in dollar terms, that's sort of interesting. But Chris, question for you: if we can't get as many cuts because actually America is booming and you do get inflationary pressures, does that mean the dollar strengthens again? I'm
very bullish the dollar. I mean, we don't trade FX at all. We have no active FX bets. We hedge out all interest rate risk. We hedge out all FX. So please don't take my advice on this. But if you want my opinion, I think the de-dollarization trend is massively overdone. The way you need to think about this is there is a profound, completely disruptive artificial intelligence revolution taking place. The ground zero for that is the United States. And you are seeing trillions of dollars spent on AI. And again, most of that money is being spent in the US. They're going to win the AI race. No one can compete with that capital, that innovation, that ingenuity. And that's going to generate massive growth, massive productivity, and will require high interest rates because high growth means higher interest rates, all else being equal. And that is very positive for the US dollar. So I think once that AI-led growth becomes clearer and the productivity gains manifest, people get more comfortable with the US. And I think as Trump's policies start to get more traction likewise, but I think that an early reflex, the sort of dump Trump trade, aka DTT, has perhaps accounted for some diversification, but I think there's going to be money pouring into the US to capitalize on the really sort of
and this AI revolution
innovation. Because just think about the innovation that's going to be unleashed by AI. It's incredible. If you use ChatGPT 5, it's amazing. So I don't see how you're bearish on the US dollar when you're getting massive capex booms, massive innovation, massive growth, and the competitive advantage that the US has over China or anyone else who wants to pretend to be an AI competitor is absolutely unassailable. Nobody can compete with that US capital.
No, although that there is a huge amount of capital that's going into AI, which is not totally, many of these companies don't make any money. And Oracle's up 37% or whatever it was the other day because OpenAI was going to invest 300 billion over the next 5 years. And yet OpenAI doesn't make any money. So there's no, what's the credit risk of OpenAI? I'm sure those bonds probably wouldn't get in a Coolabah portfolio, my guess.
Right.
And exactly correct. So there is a lot of, they've got to prove they can monetize it. And there's so much competition in the world of AI. And also, ChatGPT 4 and ChatGPT 5, the incremental benefits and and improvements of these, it seems to have sort of leveled out. We're not seeing a Moore's Law effect in AI at the moment. So it's going to be interesting to see whether it can generate revenues in the face of such incredible competition within that space.
Well, it's interesting that Elon Musk came out the other day. I don't know if you guys saw this. He gave this interview. He said super intelligence via AI is 12 months away. And he said within a few years, AI will have superior intelligence to the collective intelligence of humanity. So it's pretty serious.
He also said that robo-taxis would be running the whole world 7 years ago, and he's got 4 living in Texas at the moment. He's on 256 times earnings. His stock is more than that now, probably 300 times earnings. The entire of Tesla won't be around in 300 years. So it's a kind of, you've got to believe the growth. Let's talk about other asset classes. Nigel, maybe talk about, I know that you've always been a fan of, and I think really ahead of anybody that I know around crypto, and also talked about crypto as being a small part of your portfolio, and it's sort of a measured approach to it. The next generation, I guess, is stable coins. Could you give us, a couple of minutes on what a stable coin is and your views on that? I mean, is that going to disrupt the sort of central bank architecture or the banking architecture?
I mean, it has potential. These things take longer to adopt than perhaps people would expect. A bit like robo-taxis, maybe it takes a little bit longer to get there, but I think you'll get there. I think the direction is digitalization of financial services. So I think ultimately you send your money via a SWIFT system. It takes ages. It's expensive. All a stable coin is that it's a digital transaction. So you're using the blockchain and you're having a contract which could be written, let's say, with Ethereum, and the company that issues the dollar. Okay, so let's use an example where in America now you've got the Genius Act has come into force, and that means that a company that's approved can issue a token, which is a digital backed token, $1 backed in American treasuries. So what happens is the more stable coins are used, the more US treasuries are bought. So just think then you can transfer that to another exchange. Okay, obviously with banks accepting it, other countries accepting it, then you get fast transactions, instant transactions, virtually, very, very low cost. So Trump would like that to happen because it means that there'd be more transactions in dollar. He wants to keep, obviously, the reserve currency of the world, which the dollar has. So that would mean more trade. And then the more volume that has, they have to keep one US treasury, if you like, as part of the act. So if you think interest rates are here, the more demand there is, then that reduces the interest rate because more people buying, you don't have to, the treasury doesn't become more expensive, if you like, or the yield doesn't have to be. So America's got lots of debt. In effect, he could be reducing the cost of his debt. So it's in his interest, or in America's interest, therefore, to push in this direction. Then that, in my mind, and this is just a theory, logically means to more other digital assets. So now you're talking a percentage of your money, potentially, and then you're looking at other assets, and then do you have shares that are all digitalized? Does that mean more trade? So if you look at the stock market and indeed the bond market, you've got more and more people coming into the market. So these days retail can drive. So you think in America, 63% of Americans own stock. Okay, that's, it's a driver. It's not 80% of the trades are still funds or in actual money, but there is this more and more public buying. And you've got that same globally. So if we go equities again, the amount of people purchasing equities is going up 22% each year. So you've got more money coming in to buy stock, buy treasuries. So that, of course, then means that investments...
And that has a wealth effect. Yeah, and that has a wealth effect as well. As asset prices rise, people feel wealthier. That means people can consume. It goes back to some of the stuff that Chris was talking about, about the demand for stock. So I think, the view is really this, that, having building blocks across a portfolio is what seems to be the most important thing at the moment.
I mean, some people may seems to be growth. I mean, Chris would be, despite him being bullish on the market, he would still say that, I mean, his own personal money, I know, because I asked him last time, he would be invested in bonds because he likes the fact that there's less volatility. Okay, he's got security. He knows where he stands. Somebody might be more aggressive on here. I would say that if you're more aggressive, then obviously you can go into equities. but you're going to get volatility. You're prepared for that. So if you take the example of COVID, COVID happened, and in 33 days, the market lost 30%. Okay, nobody expected it. Okay, it happens. If you'd stayed invested in 5 months, okay, it was super quick this time, you actually made the money back and a bit more. But equities have this volatility. So unless you're somebody that is prepared for that, and when you're investing, you're looking for the longer term, I don't think personally you should be 100% in equities. So then a balance, you've got the best of equities and the best of bonds. Or if you're more cautious and you just don't want volatility, okay, well, don't put it in the bank because you're getting next to zero. Smart money funds, you've got low risk and nearly equity returns. So I think it does depend on the client.
A lot of it, Nigel, I guess, is also linked to is what your outcomes, what you want to do. You know, sometimes you're tax planning and you're thinking about, you know, inheritance tax planning, what you want to, how you want to retire, and you're thinking more outcomes with, and that's where advice really comes in. So try and understand what are the goals that you're trying to reach, and if you've already reached those goals, maybe there's no need to take that excessive risk because you now want to preserve capital.
Yeah, I'm not sure anybody's reached their goal, Matt, because inflation is edging it away. But you're right. I mean, you know, some people fairly obviously, you can have markets. You know, we all think that Fed interest rates coming down, there's a good opportunity. AI, 100% agree with Chris. There's some big opportunities in the market. Defense spending is going to go up in Europe. Okay, there's definitely opportunities. But I think we have to realize with equities, something can happen that causes volatility. So unless you're prepared for the long term, balance it. Okay, I don't think you should miss out on it, because if you leave your money in a bank account, inflation's going to erode it. So doing nothing isn't an option for me. Okay, then it's just a question of how much risk are you prepared to take and what time horizon have you got? For me, still look back and go, you know, where's the smart money going? Where's Warren Buffett going? Okay, well, you know, he's gone a bit more cautious. Is that right? Okay, well, he's a smart guy, and you'll see lots of the top managers going in similar directions.
James, did you have something?
Yeah, let's take some questions from the clients in the chat if we can.
Yep.
Cool. Would you still buy gold? An answer from all three of you. It's obviously historical highs. Would you go into it today?
Right. Well, I mean, you know, my view is with gold, if you believe in cryptos and you believe in the sort of alternative assets, this is an alternative asset. It's backed by sort of a physical feature rather than sort of promises.
Yes or no, Matt? Would you go into?
I would own a little bit.
Okay, Chris.
Yeah, I like gold as an inflation hedge. I don't own any, but I think if you're worried about inflation, it seems to be a pretty interesting diversified.
NG.
Okay, I said at the beginning of the year, yes. Okay, it's done 30% since. Now I'd go a smaller percentage. Okay, so I think, you know, you do have China buy-in, so I think there's some sort of, you know, stops it falling, but small percentage, very small. 2%, there you go.
Thank you. Matt, I thought you were very harsh on robo-taxis, by the way. So I'm just placing this on record on a recorded Zoom, and I will send you your clip when you're sat in one in a couple of years' time.
All I'm saying is that history, that people tend to overestimate the short term for technology and underestimate the long term.
This is Matthew Lamb, who said internet banking, mobile phones and Bitcoin wouldn't take off. Let's just bear that in mind. Moving swiftly on to some other questions in the chat. This is a really great question. If you guys are right and interest rates maintain at a relatively high level, should we not be concerned by household debt that seems to be continuing to go up?
Yes.
Right. Who wants to go?
I mean, I think debt's an issue. So to take Chris's point, you know, AI driving it. Okay, so let's take the US. People say massive debt. Okay, 100% correct. So just think, if you're earning 100,000 a year, let's go dollars. The US debt is 125% of its annual turnover. So think, if you earn 100 grand, your debt's 120. Okay, if your income is only paying expenses, okay, well, guess what? You've got to try and get your income up to pay off the debt. Okay, what's happening in America? The debt's increasing. I agree with Chris that America can grow its way out of it. So whilst I'm concerned about personal debt and I'm concerned about country debt, I think America's got a better opportunity to grow its way out of it than the UK. So I think the UK's got a bigger issue because it doesn't have the innovation. It doesn't have. You can grow it out, but I'd still keep an eye on it. Sorry, long answer.
So the debt for, I mean, real assets like property in the UK haven't done anything for a long time. The government's making it even harder for real assets to move through, bureaucracy and stamp duties and various other things. And if real assets don't move and wage inflation carries on, and there is sort of persistent wage inflation still higher than the UK government works, affordability effectively will start to come your way and you can start to pay down that debt. So I don't think debt is going to be solved by house prices doubling and it being inflated away. I think that what you end up with real assets, physical assets, probably tracking sideways. And that's one of the reasons why stock markets are going up, because people are moving assets which were from traditionally sort of illiquid assets, like real assets, like property and infrastructure, and moving them into more dynamic things like the equity market. So I think the debt's a problem, personal debt's a problem, but over time, I think it can be inflated away if real wages continue to rise, and that means that interest rates probably have to stay higher for longer.
Fantastic. Thank you. Chris, I love the way you separated earlier Trump's policies versus Trump's personality. I think that was a really, really important point. Often when we're reading in the media, it's all about Trump's personality. What do you think about the UK? We've obviously got a budget in November that's coming up. Seems like we've got out of control spending. Are you?
Yeah, so let's be clear, like the political reflex of choice and the playbook, which I think originated in Australia, is just to spend as much money as possible. There are some states in Australia where 1 in 2 people draw the majority of their income from government. And this creates a kind of death spiral for the region in question, because voters will just keep on voting in bad governments that spend as much money as possible to sort of allow that self-interest to assert itself. And you're seeing this all around the world, whereby hedonistic voters are being duped by myopic politicians who are just pummeling them with cash. And I think the UK is an exemplar of that. And I think it's a big problem. And we're seeing in the UK government bond market, bond bandits are saying enough's enough. We're going to continuously increase the price of those borrowings, the cost of that capital. And we've seen 30-year UK government bond yields at the highest levels in many, many decades. And it's a very, very kind of unstable situation, and it's highly, highly problematic. Ultimately, it could potentially be resolved in some sort of fiscal crisis, where bond markets impose a heinously expensive rate of repayment on the government of the day, and the government of the day is forced to remediate itself. But until voters understand what the true cost of these policies are, it's not likely to change. Just on your comments on Trump, he doesn't drink, he doesn't do drugs, he hardly sleeps. The guy's super smart. I think the first version of Trump in the first administration was polarizing and divisive because he was very inconsistent. He was getting a lot of advice from a lot of different voices. But I think he's navigated those, and he's kind of found a much clearer strategic path. And I think if you look at what he's done geopolitically, if you look at what he's done, I mean, he's negotiated tariff deals with pretty much the entire world in an incredibly short period of time. If you look at the record number of executive orders he's issued, if you look at the way he actually has more or less forced the Fed to bend the knee. The problem with the Fed was not his jawboning. The problem with the Fed was highly political before the election. Powell was more or less openly pulling for a Biden-Harris victory and trying to cut rates to help them out. That was, the consensus smart money view, not the partisan view. And the Trumpian calculus is when you come for me, I come for you. And he's just in payback mode. He's not gonna remove Powell. He said that because markets have had conniptions about that possibility. But I think he's negotiating a very, very complex environment extraordinarily well. I realize that statement in and of itself is likely polarizing for the Workahontases who are listening, but it is what it is.
Chris, just quickly on you mentioned the UK and the cost of debt. I mean, long-term cost of debt is going up globally, regardless of what, look at France, look at the US, 30-year bonds and the cost of financing. And actually, the UK has got quite an interesting playbook. It can issue debt, shorter maturity debt. But do you think there's a situation where actually you're getting paid more from government debt than you are getting from corporate debt, in the fact that, you know, many of these companies are almost better credit ratings than
Oh, 100%. We've
countries.
seen, you know, nation states are getting their credit ratings downgraded every other day. And definitely there are companies like Google and Meta and some of the super highly rated banks that are raising money at a lower cost than many nation states, because the reality is these nation states have credit risk. I mean, we don't trade UK government bonds because we think they have credit risk. We think there's just too much, it's called credit beta, but too much volatility in UK government bonds. And in our portfolio, a sine qua non or a condition precedent for coming into the portfolios, we just don't want to have any default risk. And the UK is a complete basket case, a little bit like Australia, for the avoidance of any parochial doubt.
Yeah.
Don't take this as an antipodean low blow to the motherland, but yeah, it's a basket case, the UK. And as
So Chris, just on that question, to play a little bit of devil's advocate, then, if credit spreads in corporate bonds remain very, very tight, where are you in terms of positioning? How do you actively trade credit if you end up with very high credit? It's a question from Shrenrik Jain. A very good question, in the sense that if credit spreads are so tight, how can you extrapolate that additional alpha and those cash plus returns?
So a couple of points. We get most of our alpha, 2/3, 70% of our alpha, from trading new bond issues. The more debt that is issued, the more issues there are. So these are like IPOs in the bond market, and the more opportunities we have. So we want as much debt issuance as possible because we find the cheap bonds and we flip them hours later. So that is independent of the spread levels. Like overnight, we did 6 new deals with many hundreds of millions of dollars. The second point is that not all credit is expensive. So there's two parts of the market that are relatively cheap. Bank issued senior ranking bonds, one of the safest assets you can buy on earth, AA rated bank senior ranking bonds. Their credit spreads are more or less in line with 20-year historical averages. They're well wider where they were in 2007. Senior bank bond interest rates are miles higher than they were in 2021. So they're not expensive at all, mate, right? So there are cheap parts of the market. Ironically, they also happen to be the safest and most liquid parts of that market. The other thing that's relatively...
And the biggest issuers, I guess.
Yeah, the other thing that's right, and the biggest issues. The other thing that's relatively cheap, actually, is super high-grade government bonds. So, on AAA rated Aussie government bonds, you get 4.3%. Australia has a AAA rating, the US has a AA rating, and we're getting 30 basis points a year in extra interest on high-grade government bonds in Australia than you are in the US. My simple point is that, let me express it this way. In 2021, if you bought a US Treasury, you were paid 1%. Today, if you buy a US Treasury, you paid 4%. It's pretty amazing to think. If you look at, equities today are much more expensive than they were in 2021. House prices, crypto, Bitcoin, everything's more expensive today than it was in 2021, except for government bonds. Now, there are some government bonds that I wouldn't touch with a 40-foot cattle prod. Now, for those of you who haven't worked on cattle stations, you probably don't know what that is. We shove up the ass of cows, get them moving, and it's electrified cattle prod. So UK government bonds, no, right? They're Aussie state government bonds, Victorian government bonds, no. But there are parts of the government bond market where you're getting a lot of compensation for the risks we've talked about. And the truth is, Maddie, there is actually a lot of information in those government bond yields. I mean, the Brits are having to pay the highest 30-year yield since the 1980s, and the bond market's punishing Britain for its spend.
So to the point of diversification we talked about earlier, I guess, actually what you're also saying there is the bond markets are telling us something that might be a little unnerving, which sort of, it contradicts a little bit your comments about how wonderful you think the world economy is in some ways.
Well, no, I said the US economy.
Yes. Okay. So stability is...
And the US fiscal situation, I also mentioned. So there's not going to be any deterioration at all in the US budget deficit. Trump's raising $4 trillion from tariffs, and it's 100% paying for all of his tax cuts. So Trump right now looks like a fiscal genius. Again, for the Workahontasses, that may be an uncomfortable proposition. And I'm not politically partisan.
Last question before we should go back to James, because I'm conscious of time. But the another question, which I think you'll be able to hit out of the park, Cameron Bird asked, excellent question. There are obviously clearly some credit specialists on the call, but he's asking, do you think the opacity of the bond markets, the fact you mentioned it's still generated over the phone, is that one of the reasons for these mispricings? The fact that
100%. It's like trading bonds is like buying houses. So How many rich property developers do you know? I mean, if you go to the UK Times Rich List, most of those guys are real estate guys, right? And it's because real estate's super inefficient. If you think about where you live in your suburb, you kind of know that house that traded down the street traded too cheap, right? And it's the same in the bond market. The difference is in the bond market, a little bit like the housing market, the competitors to Coolabah, without casting aspersion against any managers, they tend to be hold to maturity. They're buy and hold. And they tend to be a little bit static. I wouldn't use the word sleepy, but some might confuse that.
But you just did.
But we're hyperactive. We're hyperactive. And so we are very quantitative. We have 80 bond pricing models that we use around the world. All of our analysts and all of our traders are quants. And we're very, very high velocity. So we are completely unique in the bond market. We're like I don't know, we're like a wolf in sheep's clothing.
Well, I think in some ways you're doing what the investment banks did years ago before Volcker and Dodd-Frank. You know, the bankers made all this money by market making bonds. And then the regulation came in that they couldn't do it. And now you seem to have wrapped market making in a fund, which is, I think, is an element of genius. I don't often call him a genius, but I think that was...
that characterization is bang on. But well, I'd just like to say, guys...
Can we go back to James, because I'm conscious of time, Chris. It's 8:57. We've done 57 minutes. James, I know you wanted to wrap up with a couple of points. I mean, all your clients and team on the thing. Thanks so much for giving us all the time and giving us a voice. Thanks, Nigel. But back to you, James.
Brilliant. I mean, a big thank you from me. Another fantastic session, entertaining as well as it often is with you three on a Zoom call. Obviously, being in the right fund or funds makes all the difference. But it's not just about being invested. It's about where and how you're invested, and whether you're getting 5 or 6% or 7 or 8%. It might not sound like a small difference over a year or 2 years, but of course, over 10, 15, 20 years. The compounding effect, the difference that makes to the overall pot is absolutely massive. Matt, something that myself and you were speaking about recently, it's not just about being invested in the right fund or funds, of course. Yes, that's important. It's absolutely vital. But actually, you could say, and no offense to these guys, is that actually it's even more important to make sure you're invested in the right tax efficient structure or wrapper, as we call it. That can make an even bigger difference. It's not just about the returns. It's about what percentage of the returns that you get to keep. And of course, that's what we do at deVere. We help people plan into tax efficient structures. We reduce unnecessary taxation. So when you set up wrappers correctly, of course, it can reduce capital gains tax, inheritance tax, income tax. My advice would be speak to a regulated advisor. Speak to somebody that's regulated in your area who understands cross-border wealth management. They understand the do's, the don'ts, the local rules and regulations, and of course, those little nuances in place to make sure that you are planned and structured effectively. Matt, I always remember something that you said to me a few years ago when I was a young whippersnapper coming up through the deVere ranks. And you said to me, James, always remember the alpha is in the advice. And with cross-border wealth management, that's never more true today, is it?
Yeah, I mean, one of the things that, you know, as a fund manager, when we set up this business a decade ago, you know, one of the things that we were unencumbered by legacy, and we did a lot of work to try and understand where that alpha, and for those who don't know, that's fund management speak for secret sauce or outperformance, comes from. And I think even Chris would know, would admit, you know, if he can deliver 1% a year over the competitors, you know, that makes a big difference. But it is just 1% a year. And sometimes advice can save 40% IHT or 20%. And the other thing is, what fund managers are doing, what we do, our job is to make educated guesses. We debated a lot of those educated guesses today. And what you can do with tax planning is these are tangible, real life. You can get to control what you know. And I think a big part of the alpha in the advice is controlling what you know. And then if you can supplement that with great fund management talent that can generate that extra 1% above the peer group, you end up with that peer group outperforming cross-border advice and tax planning. And I think that we always love talking about the alpha. That's what fund managers talk about and our secret sauce. But in reality, the biggest difference is anyone will make to an investment is actually the advice they get. And as fund managers, you know, that's why we've enjoyed working with you guys for such a long time. That sort of, you know, cooperation between investment talent and tax planning, I think, is what it creates the sort of holy grail.
Fantastic. from secret sauce to cattle prods, a huge thank you to the three of you. You never shirk or duck a question. We all really appreciate that. And this is exactly why DVAN was set up, just to try and bridge that gap between the client and the fund manager, the client and the person that's managing their money. So a big, big thank you from me. If you don't have a current deVere advisor and you need some help being pointed in the right direction, feel free to contact me on LinkedIn, James Green deVere, and I shall give you a hand and help you find someone that's regulated and licensed in your area. Thank you once again, chaps.
Well done, team.
Session. Very,
Thank you, everybody. I'm sure we'll continue the debate amongst ourselves and everybody else.
Okay, yeah, we need to see what happens. So see how much comes out.
On Donald Trump, I'll go, the conclusion's correct. Okay, that actually he's lucky that companies are super robust and are getting there in spite of. But anyway, the conclusion is exactly the same. You've got a robust economy. So I think there's some really, really good points from today, and hopefully everybody can see deVere's secret sauce, if we can call it that. It is to be able to give you tax efficient advice, but also you can only access people like Coolabah via deVere. It's only available otherwise via large pensions. Okay, so the fact that we can actually offer it to retail clients, again, is part of our edge in the marketplace. Thanks, everybody. Hopefully you enjoyed it. Please give us feedback. Any questions, come to any of us. Thanks.
Thanks very much,
Take
guys.
care. Cheers.
Thanks.
Thanks, Chris. Thanks, Matt.